Here's the game changer. BlackRock's outflows of $64 million from IBIT and Ether ETFs, incredibly small occurrences, less than 0.1% of their total assets. However, the headlines shout mass unloading. They desire you to perceive this as disarray, but knowledgeable investors aren't even concerned. While smaller sellers grew worried as Bitcoin nearly reached 60K, IBIT's daily trading volume went beyond 61.5 million shares. That's not panic, that's calculated accumulation. And silver? Comex storage is hemorrhaging metal like a ruptured artery, yet every market assessment still affirms stability. Now put the pieces together. Forced liquidations on February 5th sent BTC downwards, but the unloading wasn't arbitrary. Major investors and institutional purchasers were prepared. As positions were liquidated on margin, the coins didn't just disappear, they were swiftly obtained. Simultaneously, ETFs like IBIT serve as a front-row view to the theft. $26.5 million in net inflows on February 10th alone demonstrates a synchronized accumulation strategy. While you're observing negative numbers on your holdings, the true actors are quietly acquiring supply, securing it behind regulated perimeters, and generating a shortage that will pressure every smaller trader still observing from the outside. And the silver narrative is more concerning. The Comex reported open interest displays one depiction, vast supply on the books, but the storage removals indicate something else. Every day, 785,000 ounces vanish, however contracts suggest endless accessibility. That's a deception, a trick for those short selling. Short sellers wagering against silver are aggressively advancing towards an obstacle. As the metal vanishes into physical possession, the shorts will be compelled to cover, activating a sequence that could elevate prices beyond $300 an ounce. The mathematics are ruthless. Paper contracts might assert supply is present, however, physical metal confirms shortage. Smaller traders trapped within these contracts are unaware, and the knowledgeable investors, they're organizing the pressure. Here's the crucial detail for BTC. The 66K, 68.9K range isn't just a period of stability. It's the tranquility before the disturbance. CME finalized Bitcoin at $68 to $900, rebounding from the 60K lows similar to a pressure alleviation valve. Every decrease within this range was absorbed by IBIT and comparable ETFs. The instability? Planned. Retail traders unloaded in panic. Retail traders suffered losses, but institutional entities such as BlackRock and Fidelity quietly fortified their positions. Bitcoin is no longer a speculative danger. It's security, top-ranked, prepared to support multi-billion-dollar credit accommodations at Wells Fargo, JPMorgan, and BNY Mellon. While commentators examine minor outflows, banks are discreetly establishing a stronghold around Bitcoin, guaranteeing authority over supply. Retail traps aren't exclusive to digital currency. Silver short sellers are confronting the same threat. As 785,000 ounces vanish daily, the Comex paper market proceeds to inflate open interest. Short sellers perceive a market that exists on records, not in storage. They underestimate how rapidly physical shortage evolves into a price impact. The initial few compelled covers will trigger a sequence, and when it occurs, 300+ silver won't be a forecast. It'll be reality. Every hedge fund wagering against the metal will be ensnared in a trap they neglected to anticipate. And don't forget to envision radiant silver bars vanishing from storage, Bitcoin tickers fluctuating intensely as ETFs consume coins, retail panic expressions showcased across social platforms. This is performance with a plan, a choreographed disarray. While news channels proclaim steady markets and routine modifications, the genuine narrative unfolds discreetly. Physical shortage, ETF accumulation, compelled liquidations, all aligning to generate an environment where one error by smaller traders could equate to disastrous losses. Now here's the preview. Do you assume these price fluctuations are typical? Do you believe the market is merely varying? Wait until you witness how the supply information exposes the concealed manipulators, the perpetrators behind the spectacle, the storage hemorrhaging silver, the paper contracts deceiving you. Part 2 will expose the Comex and ETF storage areas and demonstrate precisely who's controlling supply, who's profiting from anxiety, and how the East-West movements are about to rewrite the regulations of shortage indefinitely. But while smaller investors panicked over the February 5 abrupt unloading, exchanges were hemorrhaging BTC and ETH as intensely. Balances on major exchanges reached year-to-date lows even as IBIT ETF inflows soared past $54 billion. Every decrease was being discreetly eliminated, every outflow a misdirection. Retail traders observed negative numbers on their displays, assuming liquidity was diminishing. The reality: the knowledgeable investors were accumulating quietly, methodically, with exchanges transforming into emptied storage areas, while ETFs and private wallets gathered coins off-market. Now examine silver. Comex and London storage areas are leaking metal more rapidly than mainstream reports acknowledge. Shanghai premiums are increasing, signaling physical shortage in the East, while the West pretends everything is stable. Here's the highlight: paper derivatives, futures, options, contracts that exist solely as figures on a screen present an illusion of limitless supply. Meanwhile, tangible possessions, physical silver and spot Bitcoin, are vanishing into private custody. The leveraged traders who were ensnared in the February 5 devastation didn't comprehend the deception. They unloaded into anxiety, liquidations activated margin demands, and their coins and contracts concluded in hands that comprehended supply and authority. Here's the antagonist's strategy. BlackRock dictates ETF movements, possessing $54 billion in IBIT, absorbing instability, while JPMorgan discreetly oversees a $10 billion plus Bitcoin credit line. These aren't mere investments, they're implements. The Fed, rigid as always, indicates stricter policy, briefly compressing liquidity, making retail investors feel trapped. However, this is a charade. The liquidity compression is bait, an enticement that compels frantic selling, while institutions procure BTC and ETH at markdowns. Retail doesn't perceive the snare until it's too late. The Comex silver short positions are being exploited similarly. Price control through paper derivatives, fabricated supply signals, and consistent steadiness headlines generate apprehension. Short sellers wager against the metal, assuming the vaults are stocked and prices capped. Reality: actual metal is diminishing. Short sellers get squeezed, compelled covers strike like a hammer, impacting a pain floor. Each ounce disappearing from the vaults intensifies the snare. 300 plus silver isn't merely a forecast, it's inevitable if these patterns persist. History is echoing. Recall 2008? Leveraged metals positions imploded while retail investors were devastated, and informed investors profited immensely. 2020's crypto rally? Retail became anxious, succumbed to FOMO, while whales quietly amassed hoarding coins for years ahead. FTX failure? Retail forfeited billions to a mix of leveraged exposure and centralized authority. Trends recur: retail trepidation, informed accumulation, supply deficit, astonishing profits for those who grasp the system. Here's the lesson depicted in crimson and silver. What seems like disarray to the public is a meticulously planned accumulation by institutions that comprehend leverage, rarity, and timing. ETFs aren't just financial tools, they're disguised storage facilities. Vault withdrawals aren't just customary, they're proof of a gradual appropriation. And paper agreements, just a facade to maintain the masses in fear, uncertainty, and distraction. Every leveraged position liquidated, every ETF inflow quietly managed, every Comex withdrawal. It's all a component of a grander global plan. West struggling, media misreporting, retail panicking. But while this spectacle unfolds, the East is calmly hoarding. Physical silver dispatching east, Bitcoin discreetly migrating into wallets in Hong Kong, Singapore, and elsewhere, premiums escalating, pressure mounting for a squeeze that will leave Western short positions and anxious traders in the lurch. And here's the suspenseful conclusion you must remember. The supply chain isn't just numerals, it's geography. While the West flounders in panic and derivatives turmoil, The East is secretly stockpiling, boosting premiums, and preparing for what could be the ultimate global transfer of capital. Who is the clandestine purchaser? Whose hands are quietly accumulating hundreds of thousands of ounces of silver and millions of dollars in BTC and ETH, unseen and unassailable? Part 3 will reveal the East, expose the hidden actors, and demonstrate definitively who is orchestrating the next global squeeze. While the West struggles, the East is calmly re-establishing the regulations of the game. ETF inflows in the US surge, but in Hong Kong, Singapore, and other Asian centers, Bitcoin and Ethereum aren't just being traded, they're vanishing into digital wallets overseen by central banks and substantial whale accounts. Each 1,000 BTC exiting exchanges in Asia appears insignificant, but the accumulation is persistent. Ethereum is progressing similarly, quietly amassed and secured, while retail in the West panics over paper contracts, ETFs, and transient headlines. Now connect the elements. Silver is adhering to the identical pattern. Shanghai premiums have surpassed Jidito $2 an ounce over New York prices. Physical metal is being transported east, contracts remain on paper, and Comex vaults continue reporting steadiness. However, that steadiness is deceptive. The East is remitting the actual price for real silver, and the squeeze is approaching. Every ounce departing the West is a hammer impacting short positions that assumed supply was limitless. Here's the surprise. The concealed purchases aren't just private whales, they're sovereign bodies. Central banks are discreetly amassing Bitcoin, Ethereum, and silver, positioning reserves as if anticipating a geopolitical adjustment. Brazil is suggesting respite, a 1 million BTC sovereign reserve. That's not conjecture, that's establishing a nation as a global whale, capable of swaying prices and liquidity at will. Other nations in Asia are quietly stockpiling silver and crypto, establishing a safeguard against US dollar dominance, and forging a clandestine network of liquidity that retail and Western institutions can't access. Simultaneously, policies and regulatory indications in the West are influencing movements without anyone realizing it. SEC endorsements, the Clarity Act, XRP identified as a core asset. These actions aren't arbitrary. They rotate institutional demand, promote ETF inflows, and sustain the illusion of steadiness while physical accumulation transpires elsewhere. East embraces the palpable, vaults, wallets, and premiums, while the West depends on paper derivatives and ETFs to replicate exposure. Supply chain stress magnifies everything. Mining output is restricted, physical silver is progressively difficult to locate, and Bitcoin's halving cycle limits the creation of new coins. The ETF-backed credit arrangements grant banks the capability to utilize BTC as collateral, generate leverage, and absorb instability. But retail remains ensnared, struggling to comprehend why paper holdings don't equate to actual ownership. The West trades numerals, the East accumulates metal and crypto. This isn't just accumulation, it's a supply chain conflict. Every ounce of silver or coin that shifts east establishes scarcity in the West. Short positions on Comex are trapped. Whales managing ETF inflows discreetly determine Bitcoin prices, generating discount prospects for themselves and compelling retail to trade into their accumulation. As tangible metals flow from the West to Asia, pressure mounts, and the market's design ensures latecomers face a significant cost. We can't overlook the substitution effect. Silver and Bitcoin are progressively serving as safeguards against the weakening US dollar. With top-tier BTC status in ETFs, institutions can loan, secure, and sway liquidity, while everyday investors struggle to keep up. Each institutional action, every nation's accumulation, each halving and vault offload grows unseen demand and adds stress to the system. Trends are taking shape. ETF inflows, vault liquidations, premium surges, government hoarding, they all lead to a singular point. The East isn't merely acquiring, it's preparing, readying for an overall alteration in worldwide liquidity. For when paper commitments clash with true shortage, when small investors grasp that not every ETF holding equates to actual Bitcoin or silver in their possession. And here's the suspenseful revelation. All this arrangement, these built-up positions, are readying the scene for a looming disturbance to the worldwide financial framework. Part 4 will expose the underlying macro vulnerability, the concealed influences, the liquidity bottlenecks, and the ideal conditions that will launch values sky high, while the unprepared are left financially devastated. The instant the West finally comprehends the situation, the macro vulnerability will activate. Bonds are displaying explicit caution signals, U.S. debt surpassing $33 trillion, Japanese government bonds in trouble, global debt totals at untenable levels. Every financial headline shouts steadiness, yet the data illustrates a ticking explosive. In this setting, Bitcoin and silver aren't simply investments, they're secure guards as fiat diminishes discreetly around the world. Here's the crucial aspect. The Fed has restricted its options. Inflation continues to persist. Printing machines are constantly running, injecting dollars into an oversaturated system. Regular consumers observe only reduced buying capability. Meanwhile, astute firms are carefully situated in rare resources. Physical silver in storage, Bitcoin in disconnected wallets, national reserves amassed in Asia. Every dollar created brings closer impelled shortage, another impetus for the unavoidable reset. Now join the pieces. The vulnerability is foundational. Banks are unable and unwilling to safeguard your funds. Paper guarantees overshadow real resources. ETFs, futures, options, they're illusions, obscuring the true deficit behind polished illustrations and headlines. Regular consumer panic selling is the fuel, insightful amassing is the motor. Each Comex departure, every ETF inflow, every country's accumulation effort increases the tension. Picture it, silver emptying from Comex storages at 785,000 ounces each day, short positions strained, retail out of the loop, premiums rising in Shanghai, Bitcoin ETF inflows at $54 billion for IBIT, exclusive affluent wallets covertly accruing, and East-West arbitrage producing hidden demand pressure. Should the present Comex outflow continue, silver isn't simply rising, it's targeting 300 plus per ounce. Bitcoin, hanging near 68K, may jump to 71K, 73Ks in the near future. And if the East-West accumulation picks up pace as it has silently been, 85K plus is a mindful prediction. Here's the stark reality. The system is breaking down quietly, invisibly. Bonds fluctuate, fiat inflates, banks manipulate liquidity, and regular individuals are left holding paper while real wealth diminishes into calculated storages. Your chance isn't in pursuing brief numbers, it's in reclaiming ownership. Self-protection isn't optional any longer. Digital gold and physical silver are your shields against the failure of faith, the dismantling of paper, and the reduction of buying power. And for one last profound statement, they manage the numbers, the agreements, the falsehoods, but they cannot manage shortage. They cannot affect the reality of ownership. Independence is concrete. It's in the storage, in the disconnected wallet, in the ounces and coins you hold. The market can affect values, the media can fabricate fear, and administrations can advance regulation. But the deficit of silver and the durability of Bitcoin remain past their influence. Remember this as you decide on your next action. While the structure acts secure, your prosperity hinges on what is actual, what is concrete, and what is in your control. The countdown isn't a warning, it's a truth. Comex liquidations, ETF inflows, national amassing, halving cycles, they're signaling that the macro vulnerability has been created. Overlook them to your detriment. Act purposefully, secure your possessions, and watch as the collapse starts around the ignorant populations. This is the precipice of the financial structure. The West is alarmed, the East hoards, and the reality of shortage is the final decision maker. Silver, Bitcoin, and Ethereum aren't merely assets. They are necessities in a world biased against the unaware. Ownership is your freedom. Concreteness is your assurance. The rest is irrelevant. Solidify your prosperity before the system breaks down. Self-protect your Bitcoin and stock up on physical silver now. Disregard the alarm, chase the shortage, and let astute funding choices safeguard your future. Manage what they can't, your resources, your independence, your financial reality.